Thank you for tuning in to this video entitled The Price of Money, brought to you by Constructum Online Learning. This video is part of the first installment of the Business Life Stages series, the Concept Stage. In this video, I'm going to be talking to you about the cost of finance. What does it cost you to access funding from financiers? And how do you plan and manage this cost? So if you imagine going to the bank to open a savings account, your expectation is that the bank will offer you a good rate of return for depositing your money with the bank. This rate of return relates to the interest that the bank will pay you for depositing your money into the savings account. Financiers are no different. They too want a return on any monies that they loan to you in the form of interest that you pay on the loan. Consequently, you can think of interest paid as the cost of money and interest rates as the price of money. If you are going to require funding from financiers to facilitate your trading activities, like the purchase of stock that you intend to sell, then it follows that the cost of lending becomes a big part of the input costs relating to your trading activities. So understanding these costs becomes important. But more than this, you need to understand how financiers arrive at the interest rate, the price of money that they charge, and how interest rates change over time. The price of any commodity is determined by the intersection of supply and demand. Something similar applies to money, but not exactly. The South African Reserve Bank manages the money supply in the economy. In simple terms, this means that the Reserve Bank can increase and decrease the amount of money available in the economy. The Reserve Bank has a number of tools with which they can accomplish this, primarily the printing of money and managing of the repo rate. For the purpose of this video, I concentrate on the repo rate. What is the repo rate? The repo rate is the rate at which the Reserve Bank makes money available to commercial banks. From this repo rate, the banks then derive their prime lending rate. The prime lending rate is the gold standard rate at the banks. This is the rate at which the banks will supposedly lend to their best customers. All other interest rates then cascade from the prime interest rate. Residential property rates, asset finance rates, commercial, industrial and agricultural property rates, commercial lending rates, trade finance rates, and unsecured lending rates. Later on in the Business Life Stages series, I address each of the different categories of financing in detail. So look out for those videos. If you look at the graph, you will notice how interest rates are expressed as a rate of prime plus 1, 2, 3, 4% and so on. Can you see then how all the other rates derive from the prime lending rate? And if you remember what I said a few minutes ago, the prime lending rate derives from the repo rate. So perhaps now you can see why it's important that you keep an eye out for what the Reserve Bank is doing at each of its quarterly interest rate reviews. What the members of the interest rate committee at the Reserve Bank decide impact the whole economy, including your business's trading activities directly. Look at the graph below. This is a representation of the movement of the repo rate over time. Remember, all other rates derive from the repo rate. Do you notice how interest rates increase and decrease over time? In fact, economists see interest rate cycles. So where in the interest rate cycle are we at present? How does this assessment affect your view of interest rate increases and decreases over the short to medium term? If the duration of your trade cycle is short, then interest rate movements will have a small impact on the profitability of your trades. But if your loans run over a longer period, let's say 3 to 6 years, then interest rate movements may have a severe impact. Look at what happened toward the end of the 1990s, how interest rates climbed to over 25% per annum. When you look at producing your financial plan and forecast, you need to include the potential increases and decreases of interest rates into your calculation. If interest rates increase by 1, 2, 3%, will the trade still be profitable? Is it still financially viable to buy the equipment with a loan? Does it still make sense to finance the acquisition of the commercial property? You need to stress test your plans and trades by imagining a rise of interest rates of 1, 2, 3 percentage points, and then decide on the cost of finance by looking at the price of money. Thanks for listening. I hope you found value from this video. Please consider subscribing to the Constructum Online Learning platform and click the notifications bell so that you are informed when I load more content on this YouTube platform. Good luck for your business, and please let me know if I can address any specific topics and how I can improve the channel to best address your needs.